Our guest says we're going to see more choppy stock markets for the rest of the year. Let's get more from Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. Thank you very much indeed for joining us. Where should we begin? What are you paying most attention to in the markets right now?
Thank you, Andrew. Well, I think we've gone through a period of time where we've seen markets, bounce back because the level of uncertainty around some policy decisions have been removed. We know a little bit more about taxes and fiscal spending, and we've seen quality of earnings since Q1 continue to improve for publicly traded companies. However, when you look at valuations right now, and they look historically stretched. So I think when you have a morning like today with a weaker than expected jobs report, obviously a convergence on decisions around tariffs and trade, again, the market is taking a little bit of a breather. And I think academically, when you look at these types of moves that have happened where you get a 20% or more bounce back in the market, it's usually over the next 1 to 3 months, there's a digestion period. But I think when I think about this year going into next year, if quality earnings continue to be there and we see a little bit more breadth in the market than just the AI investment trade playing out, I still think that there's a healthy bull market in front of us, Andrew. It's just we have to be sensitive to things in the short term as the markets digest policy decisions and other things around the corner.
What about AI? What is your view? Because often technologies take quite a few years to produce actual payoffs in productivity. Do you think there's too much euphoria about, I don't mean the AI providers and the chips and all that, but the companies using AI? Is there too much optimism?
That's a great question. I mean, look, we've got an earnings report this week from Microsoft that showed that bottom line profits can be expanding and there is a return on that investment. However, at the same point in time, when you have an IPO like yesterday with Figma, where right now they're trading at 70 times forward-looking profits, I would say that in the space, there's definitely a little bit of euphoria that's there around AI and the themes of productivity gains. But at the same point in time, I think it's a longer term cycle. We're still talking about, 3 to 5 years having this cycle play out. And I don't think it's dead. So I think it's being selective in this environment and being sensitive to valuation on which companies you're going to allocate to.
What is your take when it comes to the U.S. consumer? Do you have a strong view there? I mean, we heard yada yada that the lower income customer is faring less well. What do you feel about U.S. stocks that are dependent on domestic demand?
Yeah, so we've been talking about with our investors how we think that over the next 12 to 18 months, the U.S. economy is going to slow, primarily due to the fact of that push-pull, as you mentioned, on price on consumer. We've seen in the short term that capital good prices have definitely gone up, which caused a shift in spending on the services side. But when we listen to what publicly traded companies have said so far through this earnings season, is you hear less of a conversation around a recession, you hear less conversations around supply chain constraints, and it seems like from where companies are going is depending on how price for services and goods play out through the global economy. You should expect price to increase in the short term on the consumer, which should impact demand. So I think moving forward, as much as there's relief from fiscal policy measures coming out of Washington domestically for the U.S., I think longer term, it's a slowing, growing economy. And that's why bigger picture, I think inflation does have some moderation. In the short term, concerns around price and inflation. Longer term, inflation comes down. That would be better for the consumer. And I also think what would be better for the consumer longer term if we start to see some rebalancing from the Fed regarding interest rates and possibly a rate cut before the end of the year and maybe some support for the economy through lower rates next year as well.
It's fascinating, really, at this time. We haven't seen duties like this imposed by America in a century. We don't know, obviously, how it's going to pan out. But are you surprised to see stock markets near record highs, given this tariff burden? I know shares are down today.
Yeah, I mean, I think it comes back to earnings and profits. And going into this year, investors were expecting profits to grow about 10% year over year. for the S&P 500, and that is now down on average to around 5 or 6%. But at the same point in time, I think if we get through this digestion period over the summer into the fall, investors are going to start looking ahead at 2026 earnings, which right now outlooks look pretty reasonable. So in light of all the headlines, let's take a step back. We are not at the proposed effective tariff rate back on April 2nd of 28.5%. When we look at the tariff announcements today and where the U.S. is on trade, it's around 15% or so. So I think investors have internalized that, Andrew, but it's also an internalization to say, well, at least it's not worse. And I think that's kind of where we are. Now, at the same point in time, tariffs being put on, Canada, tariffs being put on Switzerland, and other countries, definitely seem very punitive. And I think investors are still believing that this is a negotiation tactic that the president is using to balance out trade deficits. And I think people have accepted that this is part of the process, with possibly middle grounds that are going to be found over the weeks and months ahead. And at least I think that's the view, and why markets really haven't cratered every time that we start hearing about trade on a daily basis.